Let's look at a few practice problems involving deferred tax liabilities. This first one is a multiple choice, so feel free to pause the video here, work it out on your own, and then check your answer to the video answer. At the beginning of the year, the company purchased equipment for $800 as a 4-year useful life. The company uses straight line depreciation, of course, for its income statement. Under tax laws, the company can fully depreciate the equipment for tax purposes in the year of purchase. They have a tax rate. What will their tax expense journal entry include? All right, so we can start with beginning book value of 800. We need to depreciate to get to the end of the first year, 12/31/2024. Let's look at the income statement depreciation expense for 2024. Subtract out 200, so we have a book basis of 600. We have a tax basis fully depreciated, so the tax basis is 0. We have a temporary difference of 600. Let's multiply that by the tax rate. And we get, this is our required ending balance in the deferred tax liability account. This is the first year of the asset's life, so we don't have any existing balances in the deferred tax liability account, so we need to record a credit to the deferred tax liability account for 150, choice D. Next example, example 3, Windsor Company started the year with deferred tax liability of 150. At the end of the period, the company identifies future taxable amounts of 800. So we need, if we have future taxable amounts, we need to take that future taxable amount, multiply it by the tax rate, and that's the amount that we want as our ending balance in the deferred tax liability account. So this is our required ending balance. What do we need to get there? We need to add an additional 50 to the deferred tax liability account. So the tax expense journal entry would include well, unlike the last problem, we can't finish it at this point because this was not, the 50 to deferred tax liability is not one of our options here. So we need to look at what is the entire journal entry. Debit to increase, income taxes payable. This is our income statement amount. This is going to be our plug number. We know that we need to put in a deferred tax liability, increase it by 50, credit to 50, and then we need to record our, this should have been income tax expense, and credit for the amount we owe to the government, income taxes payable. I need to get some of that information here. The problem says the company calculates taxes payable will be 120, so our income tax expense must be 170, and that is answer choice B, debit to tax expense for 170. Example 4, shortly before the end of 2024, Coulter Company makes an installment sale that generates $400 of before tax income. The company recognizes income for accounting purposes when the sale is made, but will recognize income for tax purposes later when the cash is subsequently collected in the next accounting year. So here we have an example where we have our pre-tax income includes the revenues even before we get the cash, and that's greater than our taxable income when we get the cash next year. But we do know that our future taxes will be higher, so we have future taxable amount. And because of this, we need a deferred tax liability. The deferred tax liability is going to need to be, we can look at this as our book income of 400, our taxable income is 0, the temporary difference is 400 multiplied by the tax rate. We have a required balance in the deferred tax liability of 100. So we need to increase the deferred tax liability. This is the first year of the asset of this receivable. So there's no existing balance. We need a credit to deferred tax liability for 100. Example 5, Milo Manufacturing uses straight line depreciation for financial statement reporting and can deduct 100% of the cost of the equipment in the year the equipment is purchased for tax purposes. 4 years later, one of the manufacturing machines has a book value of $600,000. And assuming it was fully depreciated in year 1, it would have a tax basis of nothing. So the temporary difference, 600,000. We know that we're going to have future taxable amounts, so we multiply this by the tax rate. And we need a balance in an ending balance in the deferred tax liability account of 150,000. Assuming that the deferred tax liability balance was 175,000, what amount would be reported on the balance sheet, and what is the journal entry to record income taxes for this year? So part of the balance sheet amount is going to be the 150,000 ending balance. And then for that second question, what is the journal entry going to be? Well, part of this, we see that we need to reduce the deferred tax liability account by 25,000. So in our journal entry on 12/31/24, we're going to have some amount of income tax expense. We need to debit to reduce the deferred tax liability account by 25,000. And we have income taxes payable that are going to increase. Taxable income was 10 million and the rate is 25%. So our income taxes payable is 2.5 million. And so our income tax expense is the 2.5 million minus the 25,000 decrease to our deferred tax liability, or 2,475,000. And one more example on deferred tax liabilities. Ayers Services acquired an asset for $80 million in 2024. It's depreciated for financial reporting purposes over 4 years, so $20 million per year. For tax purposes, the asset's cost is being depreciated on an accelerated basis, and we see exactly what the depreciation is on the tax return. We have 25 in the first year, 33 in the second, 15 and 7. So we're giving this schedule here, we're reconciling pre-tax accounting income, showing what depreciation was in the income statement, what it is on the tax return, and getting to our taxable income. We are asked to determine the temporary book tax difference for the asset and the balance to be reported in the deferred tax liability for each of these years shown. So let's look at this from a balance sheet perspective in each of these years. The end of the first year, we have this $80 million asset. From the book basis, we subtract out 20. So we have 60, and then subtract out 20, subtract out 20. Okay, and then on a tax basis, what is the value of this asset? It starts off at 80, we subtract out 25. So it starts off at 55, and then take the 55 beginning book value, subtract out the 33 for depreciation from the tax return that we see here. We have tax basis of 22. Start with that 22. Subtract out the 15 tax deduction on the tax form. We get 7. And of course, we take that last 7 in the prior year and get down to a basis of 0. We can take the temporary difference. 2024, that's going to be 5. 60 minus 55. In 2025, 40 minus 22 is going to be 18. 20 minus 7 is 13 in 2026. And of course, nothing in the end of 2027. So we're asked to calculate the temporary book tax difference in Part A. This is the answer to Part A. and B, the balance to be reported in the deferred tax liability account, we simply multiply by the tax rate, and we get deferred tax liability required ending balance, and what would be reported on the balance sheet, $1.25 million in 2024, $4.5 million in 2025, and $3.25 million in 2026. Of course, nothing in 2027.